start, it might be worthwhile just thinking about the asset allocation decision-making process and the challenges that this experience, which has been, as we all know, has been incredibly unique within financial markets, really going back throughout history. And for those that are readers of our allocation views, a lot of this would certainly sound familiar. But as we think about this more recent period, the asset allocation decision has been a tremendous driver for really all of our portfolios, whether they focus on growth or income, and that's really the backdrop. And I think the key elements, that have really driven it is the perspective that we've had on the macro backdrop, and I think most importantly has been the tremendous accommodation. I think when history books, revisit this period in time, that will certainly be one of the more important aspects of this period. Immediately after the pandemic hit, the tremendous response from central bankers globally, the tremendous fiscal response, and that overall dovish policy, not just the magnitude, but the speed with which that accommodation was implemented had a tremendous effect on our asset allocation, principally because of what happened in rates markets. So the tremendous decline in interest rates bottoming out in the U.S. I mean, we can certainly look around the world and see, plenty of assets with negative yields, which pose their own, challenge to income investing. But the decline in interest rates in the U.S. with the 10-year bottoming around 50 basis points in the latter part of the summer of 2020, that had a profound effect on our asset allocation decision making, a swing towards risk assets, towards equity content in the majority of our client portfolios, and how we make recommendations around that asset allocation. But I think as we really drill into that for income investing, a lot of it just became a challenge, not just from the income component with rates that low and many other sectors within fixed income, taking their cue off of treasuries, particularly as markets recovered. But we also had a dynamic playing out in equity markets where growth was the darling, and certainly even those companies, even more specific within the growth sectors, those that really benefited from the conditions during the pandemic, the change in all of our livelihoods and the work from home that was so prominent. But it created tremendous dislocations and opportunity to pivot towards dividend stocks, and that's something that has been a really important theme for income investors. We think that given relatively modest total return expectations from a lot of asset classes, income, whether it be from dividend stocks or what I would like to call hybrid assets, will remain a pretty attractive element for income investing. So what do I mean by hybrid assets? And this really gets to the point of there not being a free lunch. So if you think in the most basic terms, asset allocation, the 60-40 portfolio, well, traditional fixed income, particularly with rates where they've been, and this is certainly a fluid dynamic. The 10 years gone from 50 basis points in the U.S. last summer to 1.5% today. That changes the dynamic. But in many aspects, we think there's a real challenge to see positive total returns, and that certainly played itself out in a lot of fixed income markets. Yet pivoting solely to dividend stocks certainly has real implications for portfolio risk expectations. So that's where I think the introduction of hybrid assets has been a critical component to income investing in this environment. So a simple way to think about it would be to think of equities with potentially bond-like characteristics, or on the other end of the spectrum, bonds with equity-like characteristics. So, if I think about those two camps, certainly equities with bond-like characteristics, we can then think about things like convertible securities, structured equity, even the utility sector, which I think most would acknowledge have some characteristics of both asset classes. Real estate can be a really important component in solving that income need for, many of our clients. And I would put that in that equity type assets with bond-like characteristics. On the flip side, bonds with equity-like characteristics. So moving out the credit into the credit spectrum within fixed income. So high yield, floating rate term loans would be important, aspects of solving some of that income need in this pretty challenging time. So I think from our perspective, we kind of start with that. Well, what's really driving the asset allocation? Dovish policy and that remaining supportive. A rebound in global growth continues to be an important theme for us in our asset allocation views. And then finally, the expectations for inflation, probably the most complex problem we're looking at today. But, for the time being, and the Fed has certainly delivered this message on point, that what appears to be some inflationary pressures that we're seeing in the economies today, at this point, we still are in the camp of these should not become overly problematic, and we can continue, kind of on this path.